So why does it matter to have this HSA account? It is because most Americans are already behind. Majority of Americans max out on their credit card debt. They have too many bills to pay. And over 60% of Americans are never on track for retirement. Think about it, American people tend to react to certain events and circumstances, but not planning ahead of time. And healthcare expense is one of the largest expenses that you ever face in your lifetime. But because people always just react to emergencies and they don't plan long term, they might never save enough money when an emergency happens. And that's why the HSA account is very helpful to help Americans plan ahead. Not only that, also build their long-term wealth. Over time, the HSA has become one of the biggest retirement tools that Americans can use, especially the wealthy Americans. And in Shark Tank terms, it's one of the rare deals that it gives you, again, equity, royalty, and ROI. And that's one of the deals that Mr. Wonderful favors the most. So let me show you exactly how to use it. Now, here's the catch. Not everyone gets into the tank. Not every deal matters. And with the HSA, you might wonder, how do I actually qualify for it, right? You only qualify for HSA if you are in a high deductible health plan. And people also ask me, how do I know if I'm in a high deductible health plan? It's very simple. You can open your wallet, take out your health insurance card. If you look at the right corner of your health insurance card, you'll see the amount of deductible you're eligible for. Other than that, there are other requirements that you will need to meet in order to qualify for the HSA. You cannot file as a dependent on another person's tax return except for your spouse. You cannot be enrolled in other health insurance plans, and you cannot be a part of a flexible health saving plan or any other health plans out there. And if you still worry about if you qualify or not, you can also talk to your financial advisor or talk to your CPA. And if your advisor or your CPA do not know about the HSA or they don't know how to point you towards the right direction, you can contact us at HavenStone Advisory, and one of our CPAs will talk to you directly and help you pick the best plan. We help hundreds of business owners pick the best retirement plans and the best health savings plan for themselves. Now, if you are self-employed, you even have a bigger advantage. A lot of self-employed individuals can actually go in the marketplace to pick the best health insurance plan. A lot of them are high deductible, and you have the right to negotiate with your health insurance provider as well. You can go to Fidelity or Blue Cross Blue Shield and some of the other health savings plans out there. In 2026, a high deductible health plan is defined as a plan with a minimum deductible of $1,700 for the individual and $3,400 for a family. So if you have a spouse and kids, your deductible minimum is $3,400. And in 2026, the IRS has raised the contribution limit for the HSA. So for an individual, you can contribute max to $4,400 to an HSA plan. And if you have a spouse and kids, the maximum for a family is $8,750. And so that's a significant benefit for families because you can contribute a lot more. And if you're 55 and above, you can add on another $1,000 to your HSA contribution limit. And if you have a spouse that's also over 55 years old, you can add another $2,000 total. Okay, but how much can this HSA account can save you in taxes? Now let's open the term sheet in this deal. All right, here's the HSA term sheet. And this is what Mr. Wonderful would love. Let's look into exactly what it is about. Actually, if you're in highest tax bracket of 37% and you file jointly with your spouse, your AGI is over $600,000 a year, then you can add another $8,750 into your HSA, and your family as a whole can save over $3,250 in taxes. It's almost a third of the amount you can contribute to the HSA, right? And this is the amount of money that you have full control over. You can invest this in a stock market. You can invest in the money market fund. You can also invest in real estate if you put it in the right plan. And you can also take the money out. We'll talk about this later on. For now, you just need to know that the initial most important benefit is fully tax deductible and it can reduce your taxable income. Now let's talk about the second benefit. The account can grow totally tax-free. Think about an investment account that you open with Fidelity. You can put, let's just say, $8,000 into this account. Every time this account will grow, but you also have to pay taxes on interest and dividends that you earn from this account. If you put this money into an HSA account, then the money will not only grow tax-free, but any dividend and interest you earn from the HSA account will also grow tax-free, meaning that you do not have to pay ordinary income tax or capital gain tax on this account. So think about Roth IRA, IRA or traditional IRA or 401k. You can also think about a SEP IRA or simple IRA if you're self-employed. It also grows tax-free. So this account works exactly like retirement account. The moral of the story is do not let this account sit idle. Use it to invest in a stock account or qualified account that you can grow tax-free and it can compound interest for you over time. The third benefit here is that you can withdraw money from the HSA to pay for qualified medical expenses, also completely tax-free. You can actually take the money out the exact moment that you put it in, right? So think about if you have a Roth IRA or a traditional IRA. If you want to take money out to pay for your expenses, you would have to pay 10% of penalty on that account. However, with the HSA, you can withdraw it and pay for qualified medical expenses completely tax-free. The next question people ask me is, how do I know if I have a qualified medical expense to use it the right way? And that's exactly what I want to talk to you about in the next point. Most people think HSA only covers qualified expenses like dental visit, surgery, or prescription drugs. However, the definition of qualified medical expenses is a lot broader than this. You can also take the money out to pay for childbirth-related expenses, therapy, physical therapy, chiropractor sessions, and a lot of birth control methods also qualify as well. If you go to a normal store, even go to Amazon store, there are sections that label HSA qualified, and you can also go there and ask the pharmacist for the expenses as qualified. Nowadays, you can also even use ChatGPT to ask about the expenses that could potentially qualify. And if you're still confused about it, comment below and I'll send you the list of expenses that you can use. But the real magic of the HSA is that you can invest it to build your wealth long term. So let's just say you put $8,700 into an HSA on an annual basis and the amount grows at 10% ROI on an annual basis. Keep in mind you have to put $8,700 every single year. Over 30 years, that amount of money would grow to $1.5 million. And anytime you want to take the money out, you can also do it too. So over a period of 30 years, that amount of money would grow into $1.5 million. $8,700 per year growing to $1.5 million in 30 years, that's pretty cool, right? And that's why wealthy families use HSA every single year. They use it to reduce their taxable income. It grows tax-free, and they can also take the money out to pay for a lot of medical expenses. Now, again, I've mentioned this point before, but you might ask me, how do I know if I qualify? How can I set this up? The easiest way is to ask your employer or ask your HR person, and they will lead you to the right direction. And that's if you have a W-2 job. If you own a business, you can also talk to other providers. You can talk to your health insurance providers and specifically research in the marketplace for a plan that offers HSA with the high deductible plan. Now, if you don't know how to do that the right way, contact us at HavenStone Advisory, and one of our CPAs will talk to you directly and guide you towards the right direction. Now that you understand the ins and outs of the HSA account and how it works, the next question you might ask yourself is, if I own a business or if I'm self-employed, how do I pay myself correctly? If you don't know how to pay yourself in the right way, you could easily pay double taxes in terms of payroll taxes, self-employment taxes, federal income taxes, state taxes, etc. And that's why I'm pointing you towards my next video here, talk about how to use your entity structure, LLC, S Corp, C Corp, even partnerships, to pay yourself a salary or guarantee payment correctly so that you can avoid paying unnecessary taxes. If you still want to find out more about how HavenStone Advisory works, you can click on the link below and schedule a strategy session with us. In 45 minutes, we'll show you exactly how to save your taxes. My name is Mia, and I'll see you in the next video.